Welcome to Market Pulse by Orestes Capital, your daily briefing on the key market moves, sector trends, and investment themes shaping the day. Today is Tuesday, July 14th, 2026. We're Elena and Marcus.
Right, and today we're looking at a market that is quite literally tearing itself in two directions.
Yeah, it really is.
If we pull from our daily desk data, there are really three critical themes we're navigating today. First is this massive macro tug of war. We had a surprisingly soft June CPI print that just triggered a massive relief rally in short-term bonds.
Right, but that narrative collided head-on with hawkish pushback from the Fed.
Correct. The Fed pushback and incredibly sticky long-term yields. Second, we're tracking a severely bifurcated equity market. Mega cap tech and, capital market heavy banks are pulling the major indices higher, while the underlying equal weight market is actually contracting.
Which is a striking divergence.
It is. And finally, we have to unpack this geopolitical oil shock. There is a severe military escalation in the Strait of Hormuz that sent crude prices spiking today.
Yeah, and that introduces a severe tail risk to the exact inflation relief narrative that equities are currently celebrating.
Understood. It's a lot to untangle.
Moving to today's data, we need to begin with the core driver of the session's volatility, which was that June CPI print.
Right, the data that dramatically shifted near-term interest rate expectations.
Exactly. It served as the primary catalyst for the equity rotation we saw later. Today's proprietary updates reveal that June headline CPI fell 0.4% month over month.
Which is notable because that marks the very first monthly decline we've seen since 2020.
Yeah, and core CPI was flat month over month, bringing the year-over-year figure to 2.6%. And the market reaction was immediate and violent.
Definitely.
The two-year Treasury yield dropped 8 basis points to close at roughly 4.198%. It actually hit an intraday low of 4.14%.
And consequently, dealer desks aggressively repriced the probability of a July rate hike, taking it from roughly 45% down to just 16.6%.
So before we get lost in the basis points here, I want to apply the first principles rule. Just a quick, simple explanation. If you're an everyday investor or consumer watching the two-year yield plummet today, what does that actually mean for your wallet and your portfolio?
Right. So the two-year Treasury yield essentially functions as the baseline for near-term borrowing costs across the broader economy.
Okay.
When it drops sharply like this, it acts like a pressure release valve. For regular households, it signals cheaper future borrowing rates on things like auto loans, personal loans, credit cards.
So the cost of capital in the immediate future gets cheaper.
Correct. And for the equity market, it acts as an immediate valuation steroid for rate-sensitive growth companies because, these companies are valued based on cash flows they expect to generate years in the future.
Right.
So when the discount rate used to calculate the value of those future cash flows falls, their present value automatically spikes. That's why you see that instant reflex bid in tech stocks when the two-year yield drops.
But the complication here is that the back end of the yield curve did not confirm the front end's enthusiasm.
Not at all.
The 30-year Treasury yield barely moved. It dropped just 1 basis point to close at 5.107%. Plus, we had Fed Chair Warsh testifying at the House Banking Committee today.
Yeah, and he explicitly stated that mission accomplished is not my view.
Right, reiterating that the Fed has zero tolerance for persistently elevated inflation.
Correct. The long end of the curve is reflecting a persistent term premium. Investors are demanding higher compensation to hold long-term debt because they're simply not convinced the structural inflation fight is over.
And not from just one soft monthly print.
Exactly. And we're seeing parallel structural shifts abroad that really reinforce this caution. Over in Japan, 30-year Japanese government bond yields are actively targeting 4.5 to 5.0%.
And our latest run shows exactly why that curve is steepening. It really comes down to balance sheet mechanics.
The life insurers.
Right. Japanese life insurers currently hold a negative duration gap of roughly 0.7 years, which, to put in plain English, means their liabilities, the life insurance payouts they owe far down the line, have a longer time horizon than the assets they currently hold.
So when interest rates rise globally, the math works against them.
Yeah, it eats directly into their equity. It forces them to actively sell off long-dated bond exposure just to balance their books. This is creating a massive structural deficit of ultra-long buyers in the Japanese market.
On that point, this selling pressure is happening right as Japanese retail investors are being aggressively funneled into domestic assets via the tax-free NISA program,
Right.
which our data deck shows has now grown to 71.43 trillion Japanese yen. The divergence in the rate market right now is just profound.
It's like trying to cool down a house by cranking the air conditioning. which is today's cooling CPI data, while someone else has lit a fire in the basement, which represents these structural capital shifts and sticky long-term yields.
That's a great way to put it.
The surface feels cool today, but the foundation is still running extremely hot.
Moving to today's data, we can see exactly how this rate volatility dictated sector and equity flows. Because the front-end yield curve dropped so aggressively, capital immediately rotated into rate-sensitive tech and momentum names.
Right, but looking at the underlying mechanics, that concentration really masked severe weakness in the broader equity take.
It did. The headline numbers show the S&P 500 gaining 38 basis points and the NASDAQ 100 gaining 110 basis points. Yet, market breadth was remarkably poor.
Yeah, the equal weight S&P 500 actually fell 0.36%.
Right, so you had a scenario where the indices were green, but the average stock was actually bleeding.
The rally was incredibly concentrated in AI infrastructure and cybersecurity. CrowdStrike surged 12.1%. Dell rose 7.1%.
And Micron Technology climbed 4.9%.
Capital is just aggressively crowding into the infrastructure layer of this AI trade.
Indeed. Conversely, the software and healthcare sectors face severe punishment today. IBM dropped 17% following a negative pre-announcement, citing a software and infrastructure performance shortfall.
What we're observing there is that enterprise technology budgets are effectively a zero-sum game right now. Traditional software spending is being actively cannibalized to fund these massive AI infrastructure costs.
Yeah, and we saw HCA Healthcare drop 7% after lowering its full year 2026 guidance.
This specifically cited payer mix deterioration, right?
Yeah, correct. Payer mix deterioration and health insurance exchange market membership losses. That really indicates pressure on the consumer's ability to maintain premium healthcare coverage.
We also saw the financial sector kick off Q2 earnings today with some wild divergence.
Very wild.
Goldman Sachs surged 9%, driven by blowout equities trading and capital markets revenue. JP Morgan Chase, Bank of America, and Morgan Stanley rose roughly 2 to 3%.
But then you have Wells Fargo dropping 3% after actively talking down their Q3 net interest margin expectations due to higher deposit costs.
And Citigroup fell 5%. Let's look critically at this divergence for a second. If the consumer is theoretically so resilient, as JP Morgan's credit metrics and spending data suggest, why are we seeing Wells Fargo taking such a margin hit on deposit costs?
It's a great question.
Are we simply seeing a delayed flight by retail depositors demanding the highest possible yield, thereby squeezing the regional and retail-heavy banks?
Correct. The institutional consensus right now notes that while aggregate consumer spending remains solid, the actual composition of bank funding has structurally changed.
Right.
We've entered a new regime where depositors are no longer accepting 0% on their cash. Banks with massive retail footprints, like Wells Fargo, are being forced to pay up to retain those deposits in a 4% yield environment.
Which aggressively compresses their net interest margins.
Exactly. Whereas wholesale-focused banks with heavy capital markets exposure, like Goldman Sachs, they are largely insulated from this retail deposit dynamic. They're purely capturing the upside of robust trading volumes and deal-making.
Today's proprietary updates also highlight some extreme momentum factor volatility beneath the surface. The momentum factor volatility spiked to over 3.0 times the volatility of the broader market.
Which is huge.
Yeah, that marks one of the largest three-week sell-offs on record for the short leg of these quantitative baskets. Funds that are positioned neutral to the market but long on momentum are experiencing some violent internal churn.
Understood. And internationally, we're seeing the direct result of this volatility via a textbook leverage unwind in Korea.
Right, the margin calls.
Yes. Retail margin calls on major semiconductor names like Samsung and SK Hynix really forced the KOSPI price-to-earnings ratio to plummet down to 6.72 times.
Wow. To put that in perspective for you, that is 2.7 standard deviations below its historical average.
Right. This forced liquidation collapsed, leveraged ETF assets under management from nearly $50 billion down to $27 billion in less than a month. It's a prime example of how quickly retail leverage can evaporate when high beta tech momentum stalls.
Moving to today's data, we have to pivot to the third massive theme. Because while equity traders were busy celebrating the disinflationary CPI drop, commodity desks spent the afternoon violently pricing in a geopolitical nightmare scenario.
A scenario that could completely undo that inflation relief.
Exactly. Brent crude spiked 2.6% to $85.49 per barrel, and WTI rose 2.4% to $79.89.
The catalyst there is a severe military escalation in the Middle East. The U.S.-Iran truce effectively collapsed today.
Yeah, U.S. forces reimposed a naval blockade on Iranian ports.
And in direct retaliation, Iran attacked UAE-linked supertankers in the Strait of Hormuz with cruise missiles, which tragically resulted in 2 seafarer casualties.
Now, while a proposed 20% Hormuz cargo fee was shelved after pushback from Gulf allies, the underlying military escalation and the threat to transit routes are fully intact.
They are.
Looking at our daily desk data, equities barely blinked at the oil surge. The market seems to believe this is just a localized event. But if shuttle runs in the Strait of Hormuz are materially impaired, isn't Brent at $85 just the tip of the iceberg?
It really is.
Because when you think about how this hits the economy, distillates, like heating oil and diesel, are the true inflation signals we should be watching.
On that point, distillates are the primary transmission mechanism for an energy shock to enter the broader economy. Heating oil futures hit fresh highs today, which highlights exactly how tight the refined product markets are.
Right.
The critical nuance here is that asymmetric warfare does not need to fully close the Strait of Hormuz to cause real economic damage.
No, it just needs to suppress traffic volume.
Correct. Suppress traffic volume and raise maritime insurance premiums enough to drive up end product prices globally. The equity market's working assumption that global energy flows will remain uninterrupted is currently failing a real-time stress test.
And other hard assets caught a significant bid as well today. Gold advanced 1.3% to $4,059 an ounce.
It's benefiting from a rare dual tailwind.
Yeah, the collapse in near-term rate hike bets lowers the opportunity cost of holding a non-yielding metal, and that's combined with surging geopolitical safe haven demand due to the Hormuz strikes.
And copper also rose 1.4% to 632.2 cents per pound.
Driven by optimism around Chinese demand and some extreme onshore scrap tightness.
Indeed. The copper market dynamics are particularly tight right now. Onshore scrap in China is seeing secondary operating rates down by 40%.
And the mechanism there is tied to value-added tax offset implications, right?
Right. Because scrap buyers are losing certain tax advantages, they're forced to pivot and source primary cathode instead.
So you suddenly have a massive buyer stepping away from recycled materials and squeezing the primary market.
Yes. Furthermore, anticipation of potential U.S. tariffs on cathode in 2027 is driving a massive pull forward of U.S. imports, tightening global inventories even further.
Moving to today's data, we really must synthesize these conflicting realities. We are observing falling short-term rates, highly concentrated equity euphoria, and a brewing commodity supply shock all at once.
It's a lot to balance. Our regime analysis suggests we are currently pricing in a soft landing with an asterisk.
The decoupling across asset classes is just extreme. Equities are acting entirely on the immediate relief of the CPI drop, generating massive upside convexity for high beta AI names.
However, the credit market's still a different story. They are heavily burdened. We're tracking massive capital expenditure-driven bond supply from hyperscalers.
Yeah.
Just recently, hyperscaler credit spreads experienced a 2 standard deviation widening event, simply due to the sheer volume of debt issuance required to fund their massive AI infrastructure buildouts.
And we're also tracking a new theme of innovation-driven inflation. The aggressive capital expenditure required for artificial intelligence computing power is structurally altering industrial energy demand.
It really is.
Let's unpack the PJM 2028-2029 capacity auction. It cleared at its absolute price cap of $325 per megawatt day.
Right.
For context, a capacity option is essentially grid operators paying for the promise that power will be available years down the road. Yeah. Clearing at the cap and revealing a 6.8 gigawatt supply shortfall is a massive red flag.
Definitely. Data centers require immense power.
And our data shows 56% of new data center capacity globally faces ambient cooling challenges. Think about that. Our push for deflationary technology like AI is currently so energy intensive that it is creating an inflationary supply shock in the power grid. That is a massive paradox for the Federal Reserve to navigate.
Correct. This reinforces exactly why the 30-year Treasury term premium remains entirely unbothered by the near-term disinflation narrative.
Right. The long end doesn't care.
Exactly. The capital required to build out this physical infrastructure, combined with the geopolitical risk premium we're seeing in commodities, provides a very rigid floor for long-term inflation expectations.
So what does this all mean for your portfolio? You are currently navigating a highly fragile equilibrium.
Yes, you are.
Innovation-driven capital expenditures are keeping structural economic pressures high, while the active conflict in the Strait of Hormuz threatens to reintroduce a severe energy cost shock directly into the supply chain.
If Brent crude sustains a move above $90 a barrel, the CPI relief narrative we saw today could unravel almost instantly.
which would force the Fed to pivot back to a hawkish stance, just as the market prices in rate cuts.
Exactly.
We have to ask ourselves, is this narrow, highly concentrated tech rally dangerously underpricing the geopolitical risk premium sitting right in front of us in the commodities market? Is a question every asset allocator must confront as we head into tomorrow's session.
To recap today's core takeaways really quickly, a massive downside surprise. In June, CPI sank the 2-year Treasury yield and fueled a mega-cap tech rally.
Right, lifting names like CrowdStrike and Goldman Sachs while actively punishing software and healthcare laggards like IBM and HCA.
Yet, sticky long-term yields and a violent crude oil spike driven by escalating conflict in the Strait of Hormuz suggest the inflation war is far from over.
Thank you for listening to Market Pulse by Orestes Capital. We're Elena and Marcus. We'll be back tomorrow with the latest market color.